What's going on, guys? Welcome back to the channel. Meathead Money here, and we are talking about Verizon today. Whether it's a value trap or a gold mine waiting for, some good opportunity out there. So let's dive into it. So what I did was I kind of put a couple different articles together to kind of discuss more or less a bear case and the bull case, kind of the arguments on both sides, just so it's fair. You guys can make your own determinations on it. We can kind of get into it. So for the bear case, we'll start with the negatives here. One of the biggest issues that Verizon has seen or done that they've spent a lot of money on investing in 5G and building up its network. Now, Verizon was very competitive in the 4G aspect of it and built that up, which again cost money. And now they are again investing in building up this 5G. I'll show you later on, but they're actually they're claimed to be that they're behind in some of these areas. I would argue in the bull case that it may not be what it seems. Moving on. The other issue is that with even Verizon, T-Mobile, and AT&T, as these phone companies are building out their 5G networks, 4G networks, it's increasing data usage, which is really just giving telecom companies greater pricing power. And, you would think that it would help increase the average revenue per account, but that's really not the case. Because a lot of the revenue and the value actually comes from the companies building the applications instead of the actual like phone companies that carry the data. So basically, more people are getting the benefit from actually building out the network opposed to actually just the data being used on the network. So that's kind of the downfall that AT&T, Verizon, T-Mobile have been seeing. The other issue is that with Verizon in particular, is that they pay a dividend, which as a shareholder we love, but it kind of tightens what they can do as far as a budget perspective. It kind of takes away some of their competitive edge. So, as we kind of mentioned, the massive growth in data consumption has helped stream, video, social media, gaming, but the revenue growth in these telecom companies has not been great. And the biggest revenue growth yet is still from subscriber base. So it would be customers coming in, opening up a phone plan, and then the customers paying that on a monthly or annual basis, however that works. The issue with that, obviously, again, is that with AT&T and Verizon, they offer dividends, and T-Mobile, they don't offer a dividend. So they're able to kind of use more of their cash to offer discounts and have a slightly better competitive edge. And they've actually been getting some of the customer base for both Verizon and AT&T. So T-Mobile is becoming a bigger player and a bigger competitor. So then obviously as a, Mr. Mark then sees this as an issue with Verizon stock and, values it lower than what it has been compared in the past. And, it can be seen as a value trap in the event that, most times you want to buy when the stock is low, right? You obviously don't want to buy when it's high. You want to buy low, sell high. So everyone's a lot of people looking at Verizon now and saying, well, hey, we're getting close to all-time lows, and this company has been around for a really long time. Is this the time to buy, or is this a hold and just avoid? So that's kind of what we're getting into. Other possible issues is that these telecom companies are not really able to offer good pricing leveraging because the government kind of puts restrictions on that. So just in comparison, we can see from 2011, the average revenue per account. So this is average across all of them. So this would be average of say like T-Mobile, Verizon, AT&T. So it's not just Verizon in particular, but $134 in 2011 and 2017. Didn't change much, around $136. Then actually in 2022, it had dropped to about $126. So part of the problem is that a lot of these companies aren't really even able to keep up with inflation, which has increased, about 30% during that time. So inflation is up, their pricing, the amount that they're actually, getting from their customers is down. So it's very difficult to, create a lot of revenue or don't accumulate debt when you have, you know, these types of things going on. The other component of this with 5G, so we can see here that Verizon is about 8.1% compared to T-Mobile, which is 12.5%. So this is basically, as of right now, 5G coverage, at least when this came out, which was, I believe, late June. Actually, let me just look just so I am accurate. Yeah, so June 30th is when this was written. And so you can see where it's lagging behind T-Mobile. And, again, the bigger issue is that Verizon right now, in my opinion, is a great value considering where its dividend is right now. But if Verizon does decide to cut dividends, then Verizon is very less, is less of value in my opinion if they cut dividends, which is obviously why a lot of people like this stock. A company could definitely save close to $11 billion a year if they were to completely eliminate the dividend. And if they were to cut the dividend, they could also have some savings. So that's one thing we definitely want to watch in the coming months here on what, the CEOs and management team wants to do with the company. Biggest thing is that Verizon just needs to increase their 5G coverage and make sure that they're not losing any more customer base for sure. And if not, kind of get some of that growth back to its platform. So again, the big three, they need a better network, need better pricing plans, and try to get better discounts to attract new subscribers. Similar to what T-Mobile is doing, which is why they're becoming a better player in this game compared to AT&T and Verizon. Due to this, Verizon has a limited ability of stock to get good returns because they're, in this case, the value of them growing is limited. Now, on the bull side of things, which I find interesting, is that some of this they actually agree on, some of them they don't agree on. So that's why it's good to get both sides. So overall, market cap of Verizon is about 150 billion, and right now their dividend yield is 7%, which is a great dividend yield, especially comparison to their PE and their overall share price. Cash flow actually has been up this year. Total revenue is down year over year, but their EBITDA is up, which is good. Again, it's just some financials. We can get into that more later. A couple of the other things here. So the impact this year was actually decline in the company's wireless equipment revenue. However, the wireless service revenue grew about 3% year over year. So when I looked at some of these reports, I actually had seen, which was relative to this, is that the actual cost of their phones that they're actually selling, they're almost selling their phones at a loss, but they're recovering it from their plans and some of the accessories that they sell on the phones. So that's what's actually making them profitable as a business year over year, which is good. I be honest with you, I didn't look at like T-Mobile or AT&T, but I would have to probably believe that that's similar where, they're buying these phones at a higher price and really, they're making the money on the returning customer base year over year, the dollars that they're paying for the the phone plans, and that any of the accessories they buy with it or the insurance policies. Companies earn 2.3 billion in free cash flow, which is post interest expenditures, and paid $2.7 billion in dividends. Again, that's why they have a less competitive edge. They're spending billions of dollars in dividends to their shareholders. It has $152.9 billion in total debt and 129.8 billion in net unsecured debt. So biggest red flag in my opinion with this company is just their massive debt that they have, and they really have not dropped that substantially. So they have, though, and are forecasting to continue with the increase in their free cash flow, which would be a good opportunity for them to kind of start, paying back some of this debt, which would be great. A couple of the other issues that came up in this article, again, the T-Mobile thing, difficult to compete with some of the pricing discounts they can get. But the other thing is that both Dish Network and Amazon are actually starting to kind of work together, and in which Dish Network is going to start selling plans through Amazon. Amazon, as we know, is a growing monster too, in which Amazon could potentially buy Dish Network at one point. So this could bring another competitor into the market, which could hurt both, or I should say, AT&T, T-Mobile, and Verizon. So it's something to pay attention to. But also comes up later on in the article is going to be some of the cable companies as competitors. However, those cable companies, such as Dish Network, really aren't, as of right now anyway, seen as a big threat. But with some of these inside trader deals like Dish coming with Amazon, at one point that might become more of an issue. But as of right now, it is not, in my opinion. So again, Verizon share price, close to these 28 to 2010 levels. So they're looking at this as a good time to buy in. That, based on Verizon's potential for free cash flow in the future and free cash flow currently, allows them to pay back debt. And if this would be obviously a long-term hold, that over the long term, you would be a valuable hold. And then getting into some of the other telecom companies. So Verizon has actually been selling their services as more of a wholesale through like Comcast, Charter, Dish Network, and they're actually getting paid from these companies in doing so. So these are kind of lumped together as VVNOs, which are mobile virtual network operators, kind of what they're abbreviated as. So Verizon's actually getting paid to do this. Now it's not completely black and white as to how these kind of show up on their financials and how they're kind of working in these deals. But the biggest point is that, as Verizon is growing and as they're increasing their data, the surplus wireless network, it is being monetized through some of these other MVNOs. And then the other kind of point that this brought up was that with these MVNOs, if you look at just the numbers, so collectively between like Charter, Comcast, and Dish, they had a collective subscriber base of about 19.55 million subscribers in Q1, which was up almost $1 million. So if you just look at that without taking into the actual subscriber base of like say AT&T, T-Mobile, seems like a lot, right? But if we actually go into the chart, we can see here that, so this blue one would be AT&T. So, and then the tan color is Verizon. So you can see that, these mobile companies down here, they're barely in this chart. So it seems like a lot, but as of right now, they're really not a threat when you compare them to the massive customer base, subscriber base that, these bigger companies like AT&T and Verizon have right now, which is good. But again, just keep note that there could be some of these bigger deals going on, like with Amazon and Dish, that they could steal some subscribers yet, but as of right now, they have a long, long way to go before they'd really be direct competitors. And keep in mind that Verizon is still monetizing off of some of these deals that are currently in play. And because of that, if Verizon did feel that they were starting to pull some of their subscribers away or became more of a threat, because these MVNOs are actually, like I said, using like AT&T or Verizon for their services, they kind of monopolize that in a sense where they could actually increase the rates or increase their terms that they would actually have to agree to, or they'd be kind of stuck in this middle area, no man's land, and it would make it very difficult where they would actually have to come out and spend the capital like Verizon's doing, to actually create it to scale like they would need. And right now, if you look at like Charter, Dish, I mean, they're 3 million, 9.6 for expenditures here. Where Verizon is, 23. So they're not anywhere close. Comcast is about the only one that, is up there as far as what they've got for capital expenditure and free cash flow. But as of right now, they're really not a threat based on their subscriber base. And then the other big point I wanted to bring up is that so in that bear case, they had talked about how Verizon is actually lagging in the 5G development or their 5G network. So I want to bring this up. This is actually a very good article, in my opinion. Best 4G with Verizon, they cover about 70% of 4G. And currently now, if you just look at this, you say, oh, 12%, it's way behind AT&T, way behind T-Mobile. The biggest difference, though, is that Verizon is actually focusing their 5G efforts currently on the major cities and urban areas throughout the United States, which takes about 83% of the population. So they're focusing on 80% of the market right now. And according to Root Metrics, Verizon has the best 5G experience in these cities in comparison to their competitors. So if we look here, if we look at this chart, you can see that these red dots are all the 5G network for Verizon. So they're all in the major cities, and all these orange networks are kind of their, 4G hubs. And if we just take, again, deeper look, if you look at Chicago, so they have like a super fast 5G network as well, which would be indicated here in dark red. You can see that in Chicago, a lot of this, their quote unquote blazing fast 5G is active and in, again, a lot of these major cities. So I think that's a huge player in this that's being overlooked in a lot of these bear cases, which could help Verizon get subscriber base if people enjoy using their network. That's kind of the name of the game, right? So that's kind of the two cases, just quick summary for the Bears. They pay out dividends, so they can't be very competitive. They do have competitors in the market, which I mean they've had for years. So to me, that is less of a threat. However, they are losing, some of their subscriber base to like T-Mobile, where they can offer discounts, and we get some of these insider deals going, like Dish and Amazon as an example, which as of right now cannot, aren't really looked at as a threat, but could be. And then on the bull case, the, I guess the argument would be that, well, yes, there are some of these companies that are out there like Charter, Comcast, that, could come out and potentially be competitors or taking subscriber base, but Verizon is actually monetizing from the companies using their services. And yes, that they may not have as much quote unquote 5G coverage, but their coverage is in the major cities where 83% of their customer base is. And if they give them a good experience, that could keep subscribers or bring customers back to Verizon. Good free cash flow and looking to lower debt and having a dividend payout to keep shareholders happy. So I think those are all good positives. Share price is close to lows and could be, again, valued again as a good buying opportunity. Bear case, they're seeing as a value trap. Okay, so let's look at the financials and why I think this is a more or less a good buy. So if we look at dividend history, which again, this is what, in my opinion, makes a stock very appealing. 7% dividend payout right now. They've had consistent payouts for 22 years, and 18 of them they've seen growth. So we can see, this chart, if we just go to the max here, you can see a nice steady increase over the course, of their 22 years. And in some areas it was, I guess kind of flat, but either way, they've had shown growth. The disadvantage, is that their growth, because they are kind of been around for a while, they're not growing too great, but it's a good safety net if you're looking for some nice, steady, passive income from a dividend stock. So even, 1.5% to 2% is kind of what their typical dividend rate has been. And, their dividend yield, like I said, right now is 7%. So great opportunity for some passive stock. We just look at the overall rates here. So they've got a forward PE right now of 7.93, so it's under 10. And again, their big competitors would be like AT&T in this list. If we just go to their financials here, just kind of always want to double check these statements here, guys. You can look at articles all day, but it's good to just double check some of the stuff to make sure they're actually accurate and they're not blowing smoke. So we can see net income 2015 to today, it's been up, relatively close here. Find that overly alarming, and it's also keep in mind that they go through this COVID, and we're in a recession, so we're not in the best market right now. So they're still holding their own. The one thing, let's see, free cash flow. So the free cash flow, which is really good, has for the most part been increasing over the years. They were down quite a bit during this time frame, which 2021, and they've substantially increased from 2021 into 2022, and year over date they've still increased that, so that's good. That's what they can eventually use to continue paying off their debt. Look at their balance sheets. Again, this was kind of like the red flag that I mentioned before. It's just that their total debt has just been increasing, which isn't really necessarily what you want to see for a company. However, their assets, have been maintaining for the most part, and they've been able to maintain their dividend, which is great too. So, and again, revenues for the most part, they have been increasing or maintaining. So again, they're not losing money necessarily, but their debt is kind of the bigger issue with that. So that being said, I think it's a good buying opportunity. If you look again, over the past 5 years, anything under $40 really would be a good buy. However, I think now we can get it even below $36, so that would be kind of the ideal thing if we can get it. If we look here, $32 is kind of like the lowest over the year. Did kind of bounce back up around that $40 range, and it's been kind of slowly, pumping and dumping from there. But I think even right now, $35, $36 in that range, it's been holding that for the past couple months. And I think this does have potential to start coming back up on the rise here, especially with, we'll see what happens with rate hikes and what the Fed ends up actually doing and how that's going to affect things. But they're still paying the dividend. So you guys are still making 7% off the dividend. The biggest thing that would really devalue this stock, in my opinion, would be if they decide to cut dividends. If dividends are cut, the valuation of this would, in my opinion, decrease quite substantially. The other thing I want to look at too, if we just look at the ratings really quick to see what Wall Street is targeting this at, $43. I've seen anywhere between $41 and $43. So if you were to buy it, now you'd be looking at almost 20% upside over the long term, which is a great investment, return on your money. Plus, you're still getting your dividend payout too, which they've been continuing to grow over the course of the years. So I think it's a good opportunity. Let me know down in the comments what you guys think. If you liked the video, smash that like button, subscribe, and let me know suggestions on any other videos you guys want to see in the future. Appreciate it. See you on the next one.